All right, so you've got this brilliant idea, right? You think it could be the next big thing. But how do you convince a venture capitalist that it's not just a cool thought, but a real, world-changing business? Let's dive in and break down exactly how VCs vet your idea to see if it's worth a massive investment.
You know, this is the core question every single VC is asking themselves. They get flooded with hundreds, maybe thousands of good ideas every single week. But what are they really hunting for? They're looking for that one tiny, rare signal that separates just another cool project from a potential billion-dollar company. And here's the very first hurdle you gotta clear. See, a VC doesn't fund an idea. An idea is just a thought, right? Anyone can have one. They fund an opportunity. And an opportunity? Well, that's a whole different beast. It's not just about creating value. It's about having a rock-solid plan to capture that value and build a real, lasting competitive advantage.
And that right there leads us to the holy grail for any VC. Seriously, this is what it's all about. They're not in it for a quick flip. They're looking for a sustainable competitive advantage. I mean, they're investing for the long haul, thinking 8, maybe 10 years down the road. The big question is, can your business consistently beat everyone else for an entire decade? That's the real test.
So how do they figure that out? Well, VCs basically run every single potential investment through this gauntlet. Think of it as a series of 3 brutal but absolutely essential tests. If you can pass all 3, then you just might have a business they're willing to write a big check for.
Okay, let's jump into it. Test number 1 is all about creating value. This is the foundation, the bedrock. It all boils down to a super simple question of basic economics.
And here it is, the golden rule. Value has to be greater than cost. It's that simple. Does your thing, your product, your service, does it give a customer more value than it actually costs you to make it? Because if the answer is no, the conversation is pretty much over before it even begins. Game over. But of course, VCs like to break this down even further. So the total economic value created actually has 2 pieces. First, there's the value your customer gets. That's the gap between what they'd be willing to pay and what you actually charge them. Think of it as their win. The second part is the value you get. That's your profit. A truly killer opportunity creates a huge surplus for both sides of that equation. It's a win-win.
So the big question is, how do you actually make sure your value is way bigger than your cost? Well, there are really only 2 ways to do it. You can either be a cost leader, kind of like Ryanair or Indigo Airlines, and just be relentlessly, radically cheaper to operate than anyone else. Or you can go the complete opposite direction with product differentiation. Think Ferrari. You create something so awesome, so desirable, that you massively increase what a customer is willing to pay for it.
All right, so let's say your idea passes test 1. It creates value. Fantastic. But can it survive out there in the wild? That brings us to test number 2, which I like to call surviving the arena. Because look, it's not enough to just make money. You have to be able to defend that money from everyone who's going to come after it.
Yeah, this quote really hits the nail on the head. A VC isn't just looking at your company in a vacuum. They're looking at the entire industry structure you're playing in. If that industry, by its very nature, is designed to just squeeze profits out of everyone, well, that's some massive red flag for their investment.
And to analyze this whole arena, VCs often pull out a classic tool, Porter's 5 forces. The easiest way to think about it is this. Imagine your profits are in a big bucket. Each of these 5 forces is a potential leak in that bucket. The stronger these forces are, the faster your hard-earned profits are going to leak out and end up in someone else's pocket.
Let's make this real with an example. Imagine an idea for an insurance company that pays out to businesses on rainy days. Now, at first glance, this looks pretty good, right? Not much competition, not many substitutes. But a VC digs deeper and sees all the threats. Sure, customers don't have many alternatives, but that gives them some power over pricing. You need pricey data analysts to even make this work, so your suppliers have power over you. And the biggest question of all, what's stopping some giant insurance company from just waltzing in and crushing you once you've proven the market exists?
So you see, even with what looks like low competition on the surface, all these other forces are squeezing your potential profits. A VC would look at this and say, this is a medium opportunity at best. And you know what? VCs are not in the business of medium. They're hunting for grand slams, for home runs. So this idea, it would almost certainly be a pass.
Okay, let's say you've passed the first 2 tests. Your idea creates value, and the industry arena looks pretty good. Now we get to the final and maybe the most important test of all. The secret sauce. What makes your team, your company, uniquely capable of winning this game. To really nail this down, VCs have another framework they love. It's called VRIO. VRIO. They're basically looking for a special resource or capability you have that checks 4 boxes. Is it valuable? Is it rare? Is it hard to imitate? And crucially, is your company organized to actually take advantage of it? This is their checklist for finding a real, defensible advantage. So let's just walk through these one by one. First up, V for valuable. Is your secret sauce actually valuable? I mean, you might have the most brilliant engineering team on the planet, but are they brilliant at solving a problem that customers will actually open their wallets for? If your key strength doesn't directly help you win in the market, then it's not a valuable resource. It's just a vanity metric.
Okay, so it's valuable. Check. But is it R for rare? A lot of founders get tripped up here. Saying you have great customer service isn't rare. Sorry, but everyone says that. A truly rare resource is something very, very few competitors have. We're talking about an exclusive patent for a key technology, or a one-of-a-kind data set that nobody else has managed to build.
Next up, the really tough one, I for imitable. Can it be easily copied? This is where so many ideas fall apart. Even if your advantage is rare today, how hard is it for a big competitor with a ton of cash to just copy it tomorrow? A true moat, as they call it, means it would be insanely expensive or take them years and years to replicate what you've built. Think about the brand loyalty Apple has built over decades. You can't just buy that.
And finally, we have O for organized. Are you actually organized to exploit this amazing resource you have? Honestly, this is another huge pitfall. You could have the most valuable, rare, and impossible to copy resource in the world, but if your company's internal structure, the way you pay people, your whole culture, if none of that is aligned to take advantage of it, then that amazing resource is basically worthless. So, that's the gauntlet. That's the intense screening process a VC will put your idea through. Which, of course, begs a pretty big question. Where do winning ideas even come from? How do founders actually stumble upon these rare, defensible opportunities in the first place?
Well, a huge piece of the puzzle is actually in your network, but maybe not the part you think. It's your weak ties. See, your strong ties, your close friends, your family, your coworkers, they tend to know all the same stuff you do. It's a bit of an echo chamber. But your weak ties? Those are your acquaintances, people you know from different industries, different social circles. They are absolute gold. They're the bridges to totally new domains and new ideas. That's where the real magic, the real sparks tend to happen.
So if you look at the toolkit of a successful entrepreneur, it kind of looks like this. First, they leverage those weak ties to get a flood of new, novel ideas. Second, they have something called absorptive capacity, which is just a fancy way of saying they have enough prior experience in a field to actually recognize the value of that new information when they see it. And third, they have the creativity to take old ideas and recombine them in completely new and powerful ways.
And of course, there's one last piece of the puzzle that we can't forget: timing. You've heard it a million times, but timing is everything. VCs generally aren't looking for markets that are so new they're completely undefined. And they're definitely not looking for markets that are already jam-packed and saturated. They're looking for that sweet spot, an industry that has some structure, some stability, but still has a ton of room to grow. That's the Goldilocks zone.
So there you have it, the VC gauntlet in a nutshell. Now the ball's in your court. It's your turn. Take your own idea, your own passion project, and run it through these 3 brutal tests. Test 1, value creation. Test 2, the arena. And test 3, the secret sauce. And then ask yourself the honest question: is what I have just a good idea, or is it a true fundable opportunity?